Several cryptocurrencies on the Binance exchange collapsed and hit zero. What or who caused it? Is it a technical failure, or are we looking at a coordinated attack? Meanwhile, Donald Trump confirms that the United States and China are in a full-blown trade war. So why aren't markets falling? Bitcoin, Ethereum, and XRP Ripple may be flashing a unique buying opportunity. Let's break it down. On October 10, the crypto market lived through a Black Friday no one will forget. In a matter of hours, the sector shed almost $850 billion in market cap, the biggest plunge since the FTX collapse. Bitcoin dropped between 10% and 15%, sliding from $124,000 down to $105,000. Altcoins were hit even harder, especially those traded on Binance. Several tokens like Cosmos, IoTex, or Engine printed prices near zero inside Binance, while on other exchanges they fell only about 46% to 64%, and only is doing a lot of work here, but that's basically the real drop. Everything pointed to a Binance-specific issue, and explanations soon began to surface. Everything points to a collapse driven by a massive wave of automatic liquidations. When a trader uses leverage, borrowing money to increase position size, and the price falls too far, the system auto-liquidates the position to repay the loan. This time, liquidations reached nearly $20 billion, 20 times more than during the 2020 crash, wiping out funds for more than 1.6 million traders. BitMEX per-founder Arthur Hayes explained that major exchanges, including Binance, began selling collateral tied to cross-margin positions, amplifying the domino effect. On top of that came technical glitches, frozen accounts, and orders that failed to execute as the system became completely saturated. Meanwhile, some market makers pulled liquidity due to delays. In those seconds, with no buyers or sellers, prices on Binance literally printed zero, even though the coins still had real value elsewhere. But the panic was already in motion. Binance acknowledged the issues and promised to compensate users who can prove losses caused by technical failures. However, it clarified it would not cover losses stemming from normal market volatility. Days later, the exchange published an update. According to the company, prices hadn't truly fallen to zero, it was a display issue. The error stemmed from a recent change to the number of decimals allowed in certain pairs, like IOTX and USDT, which caused prices to show up as zero on the interface. But not everyone was convinced. Some analysts, like Elon Reich, floated the possibility of a coordinated attack exploiting a vulnerability in Binance's unified account feature, which relied on internal price oracles. Under this theory, the exploit caused USDT on the Ethereum network to lose its peg and drop to 65 cents, triggering a cascade of liquidations of up to $1 billion inside the exchange. All of this, they argue, pushed Binance to allocate $283 million in compensation. And it all unfolded against an already tense global backdrop. Just days later, President Donald Trump said the United States is already in a trade war with China after threatening 100% tariffs on all Chinese imports. China responded by tightening export controls on rare earths, minerals that are critical for manufacturing chips and advanced technology. Trump framed the tariffs as both economic defense and national security, saying they aim to protect the U.S. tech industry and reduce dependence on Beijing. Treasury Secretary Scott Bessent called China's measures disappointing actions and warned this is China versus the world. The impact was felt domestically too. The U.S. Bitcoin mining industry now faces taxes of up to 57.6% on hardware imported from China, significantly raising operating costs. Meanwhile, looking at a positive long-term angle for crypto, on Capitol Hill, Republican lawmaker Troy Downing introduced a bill to codify Trump's Executive Order 14,330, which allows cryptocurrencies and alternative assets to be included in 401k retirement plans. The proposal seeks to make permanent a measure that for now remains temporary. The Department of Labor, the SEC, and the Treasury have 6 months to adapt the rules, and while the idea is divisive, for the crypto sector, it marks a historic step towards institutional adoption in the United States, and of course towards greater liquidity and stronger demand pressure for Bitcoin. Interest in digital assets, however, isn't confined to US policy. After last Friday's market drop, which wiped out $74 billion in leveraged positions, there was a major shift in the global trading balance. For the first time, the Chicago Mercantile Exchange surpassed Binance in open interest for Bitcoin, Ethereum, Solana, and XRP futures. This shift reflects that both institutional and retail interest in crypto continues to grow. Any additional liquidity and demand pressure flowing into crypto will, of course, be more than welcome. And it's precisely this structural evolution that's confirmed by the latest report from State Street and Oxford Economics, showing how institutional investors are steadily increasing their exposure to cryptocurrencies and technologies like blockchain and artificial intelligence. According to the study, crypto assets already account for roughly 7% of institutional portfolios and could reach 16% by 2028. Most of these investments are concentrated in stable coins and tokenized assets, though Bitcoin and Ethereum remain the favorites. In addition, nearly half of respondents believe that generative AI DeFi will accelerate the development of the crypto ecosystem by making it easier to create smart contracts and more secure blockchains. Taken together, the report points to a hybrid model between traditional and decentralized finance, where adoption moves cautiously but steadily. Large investors aren't seeking total disruption. They're pursuing a gradual integration of digital assets into the global financial system. Now, let's move on to Bitcoin and the broader crypto ecosystem. In the medium term, retail investors are without a doubt selling Bitcoin right now. And I think you know what we do at Crypto Insight when we see retail moving one way, we often prioritize looking in the opposite direction. I'll explain that in a moment. But first,
welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
You're now looking at Bitcoin's chart on the 4-hour time frame. Notice how last Friday's flash crash was a truly spectacular Black Friday. The big institutions played it rough. There's no doubt the strong hands were the ones behind this entire drop. It's always the usual suspects. So I encourage everyone not to fall into conspiracies, because behavior like this, as I explained in the last YouTube Live, can happen in any kind of financial market. We've seen this before. Oil prices trading negative, and the British pound looking like it might drag an entire country to the brink. So don't get mad at Bitcoin or crypto, and don't assume it's inherently unsafe. Events like this can happen, but look at the read we're giving it. Let's not forget the institutions marked out a defense zone. After that big rally, they came in to defend it. The strong hands and smart money defined an area we shouldn't break into. They drew a line they're not willing to see lost to the downside. In fact, during the flash crash, notice this, the moment price started to plunge, how curious that it had an urgent need to stop right at the defense zone. I'll tell you up front, in this world, coincidences don't exist. With that in mind, let's zoom in to Bitcoin's chart. From what I've been analyzing, we're currently in a range, and in my view, a genuine accumulation process is taking shape. There's no doubt institutions injected heavy buy orders here, which is why I think price will keep accumulating in this area. In fact, I expect a sneaky bearish climactic move before a recovery that eventually pushes higher. Why do I expect that? We're about to look at an indicator that tracks the total number of accounts buying or selling Bitcoin. This isn't about volume. It's about the count of accounts. So a whale buying or selling a lot won't distort the data. And that's what matters to us, understanding what retail is doing. First, I have to show you this. When retail is buying, look at this uptrend in the metric. Notice how poorly they time it. Retail keeps buying while price is clearly trending down. Look, retail bought here, 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 and here. They bought all the way through the decline, and it went terribly. Basically, retail behavior acts as a contrarian signal for us. This is just one example, but I could show you several more. Look, during this market phase, what was retail doing? They were selling. And what were the institutions really doing? Accumulating to push higher. As price kept climbing, what did retail keep doing? Selling like crazy, because retail thinks it's smarter than everyone and tries to flip the market constantly. As I was saying, I could show you 1,000 examples. In fact, you're seeing them on screen right now. Throughout this whole phase, retail was selling, and look what price did. A reaccumulation, then up. Here we have retail buying. Then, again, through this phase, retail was selling. And what did price do? Another reaccumulation and higher. Retail sold. What did price do? The opposite. It climbed. Okay, enough examples. Where does that leave us now? I'm not sure if I mentioned it earlier, but we're looking at Bitcoin on the 1-hour time frame. Broadly speaking, retail is currently selling. That already gives us a small clue about the bias institutions might have. Remember, whale appetites are fed by retail liquidity. That's why, as contrarians to retail behavior, we can lean bullish. But if we bring this to the short term and look at what's happening right now, what is retail doing? Look closely. Retail is buying like crazy at this very moment. And what has price done? The exact opposite. It's been dropping. Why? Because retail has no idea what it's doing. That's the harsh truth. Unfortunately, because our job at Crypto Insight is to give retail investors advanced, rigorous technical analysis so they don't keep falling into the same traps you're seeing on screen. So what does that lead us to think? Well, if retail is piling into longs, wouldn't you want to see a bearish climactic move to flush out all those leveraged longs in the short term? And once they're liquidated, price can move higher. Because broadly speaking, speaking, retail is still net sellers. And if we take this to the classic price chart, what was I telling you a moment ago with Bitcoin? On the 1 hour time frame, it looks very plausible to clear out this structure to the downside before eventually moving higher. This analysis I'm sharing is something we already covered in recent Crypto Insight Premium live sessions inside our private Telegram community. What am I getting at? We don't actually need to see or study what retail is doing with that previous chart to reach this view, but that doesn't mean it can't help confirm our thesis.
I want to introduce you to our private Telegram channel, which is completely free. In fact, at the time of recording this video, we're also live streaming for the community. During these live sessions, we look for trading opportunities in the futures market. We focus on intraday trades, and within this community, members also share their operational ideas, what they're working on, and what they're looking for in the markets at any given moment. It's honestly very interesting. This community is constantly learning and improving. So if you're an active trader and tired of trading alone, you can join our community. It's very simple. The requirements are as follows. You need to be a user of BitUnix or BuyDFI, have deposited cryptocurrencies into your BitUnix or BuyDFI accounts with a minimum value of $100.00, and use this account as your primary futures trading account. In other words, you need to be actively trading. Once you've met these requirements, simply fill out the form displayed on the screen. It consists of just 5 simple questions, and we'll get back to you as soon as possible. I'm leaving you the BitUnix promo details and the Crypto Insight Premium Access form in the description and pinned comment of this video.
Before we look at XRP, Ripple, let's analyze Ethereum. Notice how the drop doesn't seem to have damaged its price action much. At most, it simply tapped a key defense zone. Now, if we drop to the 1 hour time frame and zoom in a bit, we can see price already reacting at that defense area. That's quite plausible because after this accumulation phase followed by an impulse, we believe institutions are defending their position at that very zone. Honestly, we don't know if the trap will show up before price takes off. It might or it might not, but overall we're bullish because if you look at what retail investors are doing in Ethereum, it's pretty clear. Retail is selling. They started selling here. Terrible timing, right before price ripped higher. In general, they're still selling, so our bias should be bullish, of course. And if we zoom in a bit on this 1 hour Ethereum chart, here's what stands out. When price had already recovered and was trading up here, that's exactly where we see retail buying Ether. What can I tell you? Does it make sense that if retail is buying and we give it time for them to notice the V-shaped rebound, get optimistic and buy because they feel late, then a shakeout becomes very plausible. Picture a bearish trap that entices retail to buy, and once that trap springs, since retail is net sellers at the macro level, price can then move higher. Notice how Ethereum's analysis lines up with Bitcoin. Brought back to the classic price chart, what can we expect? A trap around a defense zone would be very interesting before coming back to break that big creek. That's the idea. And with Ripple's price, ticker XRP, here's what we're seeing. For all the Ripple fans out there, institutions have been defending a key zone. After the crash, price pierced it as a fake out. Big volume, big bid. It was basically absorbed and then price pushed higher. From my perspective, it's pretty clear. With Ripple, we can expect exactly the same playbook as with Bitcoin and Ethereum. Let them come in and scare the market. Why not something like this? They show up, spook everyone, a little bear trap, and people start thinking crypto is going to zero. That's the point where XRP, Ripple, for friends, can recover. And then what could the bullish leg we're expecting in crypto bring us? Now tell me, what are you prioritizing at this moment? Looking for longs or shorts? How do you think the trade war between the United States and China will impact crypto prices? Drop your take in the comments. And if you enjoyed this advanced technical analysis, give the video a like, subscribe to the channel, and hit the bell so YouTube lets you know about future uploads. And of course, share this video with your friends, family, and other trading or crypto communities. Good luck with your trading. I'll be waiting for you in Crypto Insight Premium. See you next time.